Thank you, Phil. As he mentioned, my name is Lydia Beyoud. I'm a FinTech reporter, and we've got a great lineup of experts from the FinTech and RegTech space to delve a little deeper into Treasury's 200-plus page FinTech report. So briefly joining me is Jonah Crane, Executive Director for the RegTech Lab. Next, we have Colin Darke, General Counsel at Rocket Loans. Joanne Barefoot, CEO of Barefoot Innovation Group and co-founder of Hummingbird RegTech. And last but not least, Peter Renton, founder of Lind Academy. So guys, I'm going to start off by asking you to respond to Craig Phillips' remarks, and of everything that he went through, what did you sort of take away as sort of most immediately actionable or pressing? Why don't we start with you, Jonah?
Sure. So I'll start with right where Councillor Phillips started, which was to say, you know, he remarked that it's interesting and fun to work on these issues because they're new. They present new intellectual problems and challenges. And I know when I was on the policy side, they were interesting for that reason and because they're sort of not a set of issues that have been ground through the political mill over years. And so you can sort of think about them in a new way without quite as many political constraints. And I think one of the interesting areas to highlight that sort of fits that mold is the issue of consumer data access, which Councillor Phillips mentioned and was discussed over like 22 pages in the report. And I flag it here partly because I'm self-interested. I am, full disclosure, an advisor to a company that provides consumer data access, but also because it is so critical to so many of the innovations that we're all talking about all day today and at FinTech conferences across the country. Really at the core of that is the ability of consumers to access and obtain and permission access to their data so that they can access the new and innovative products out there. And so I think that's a really interesting issue. It was a big priority for Director Cordray when he was running the CFPB, and the Trump Treasury Department also recognized the importance of it and highlighted in their report. And I think that's a good example of ways in which these new innovations are bringing new issues to the fore, and we can sort of think about them with a clean slate. The only other one I'd highlight is he mentioned the importance of partnerships, and that's also sort of critical. So consumer data access on the retail and consumer-facing side, but in the B2B side and all the things that financial institutions are trying to do to improve their risk management, to improve KYC and their BSA AML compliance, these are all going to be facilitated largely through partnerships and vendor arrangements. And so that focus on partnerships is critical, and I know the regulators have been spending a lot of time thinking about it over the last 6 to 12 months and probably even longer. So those are a couple points I'd highlight.
I really appreciated the speech and the report, and throughout the day I was kind of surprised where I do think there's a lot of nonpartisan, there's a lot of agreement, there's like bipartisan support for a lot of the initiatives, and Councilor Phillips took the initiative to kind of step back and put together like an overarching view of FinTech and what are some of the headaches and just putting this necessary push on regulators in general, including federal and state regulators. With one of the quotes I took down is, to innovate, you have to take the first move. And that was in light of the sandbox, but the idea of pushing to testing new credit models and codifying valid when made doctrine, and just kind of throwing the issues out there. And I don't think there's anything controversial about throwing what the issues are and throwing where there's disagreement and pushing the industry and pushing the various regulators to take action. And that is how you innovate. And that's what's great about OPI and the summit, is getting all the right people in the room to say, yes, we do agree with consumer protection. We do agree with giving guidelines and structured innovation, but we want some standards. We think some model laws might help here. We think some passporting and this continued dialogue among the states will help, and putting a timeline on it, because the 3-year timeline for kind of the FinTech and the states to come together with some uniformity. That's how things get done, is when there's a timeline. So that was my biggest takeaway. Just a needed push, which everybody appreciates.
Yeah. I think the report is exceptionally good, and even more exciting than the report is the fact that it's got a vision for how to actually get there, how to make progress toward these goals. We're in the process of digitizing finance, and fewer people realize we're also digitizing financial regulation, which means we can make it better, faster, and cheaper, and make it a platform for innovation. And we're going to have to speed up. I'm a former bank regulator. I have no criticism of the regulators, but they're built to be slow and careful and cautious. And so the question is, how are we going to go faster? And this report highlights the two keys to that. One is greater collaboration, both among the agencies and between the agencies and industry, and the other is the sandboxing and testing capability. Those are accelerating mechanisms, and as those, and this is happening. I think people don't realize how much the U.S. bank agencies today are all setting up innovation initiatives and connecting up with each other in ways that really they weren't doing even 6 months ago. So there's a lot of progress toward practical outcomes in it that I'm really impressed with.
So the thing that Councillor Phillips said that really struck me most was, and I really appreciated his honesty here, he said that the current regulatory structure in the United States is not competitive internationally. And I think that is something that really should light a fire under all the regulators. And I think, you know, there are other places that you go in the world where it's simpler. You don't have to deal with the 50 states and the different regulatory agencies. Sometimes there's one or two regulators, and that's it in its entirety that a fintech company has to deal with. And I think, you know, but for the fact, and I say this as, you know, I am a US citizen, but I wasn't born here, so I have a different perspective than a lot of people. And, you know, but for the fact that the US economy is so large, we would be languishing when it comes to fintech innovation. Just the mere fact that we have, you know, we have such, we attract a lot of companies. As someone who was born outside of this country, you know, when I you know, became an entrepreneur, I wanted to come here, because if you can make it here, then you've really made it in the biggest economy in the world. And I think that's what I worry about the way that the regulatory structure is set up today, is that people in fintech don't necessarily want to come here. They might say, there might be an Australian entrepreneur saying, you know what, I'm going to go to the UK first. I'm going to go to, you know, Canada even first, or some other, just to really make it, because it's simpler to do and it's less brain damage in trying to get something set up. So as Joanne said, I feel it's great that they have really got a framework in place to take action, because that's what we need to see. I don't want to be sitting here in 3 years' time talking about, well, you know, we're still talking about action and we haven't actually taken it. So anyway, that was my big takeaway.
Okay. I want to circle back to the topic of sandboxes, and specifically a theme that I think has come up in every single panel, including several of you just now, with regard to coordination. The Treasury FinTech report really underscores the need for it to make some of its policy objectives a reality. So when we talk about a FinTech sandbox, what do you envision that looking like depending on the agency or the state, and what sort of coordination do we really need? Joanne, let's start with you.
So I have come to believe, and it wasn't obvious to me in the beginning, that regulators have to have sandboxes, that you can't speed up unless you've got some kind of a test bed where, and the key to it that people underestimate is that one of the huge benefits is the regulators learning. It gives them a way to get hands-on and close to these innovations, and you can't learn them by having a PowerPoint during, you know, holding office hours, or by even regulating it over time. So there's a lot of models globally. The UK's sandbox has been kind of the most emulated one, but there are many versions. They all have the attribute of, pretty much all have the attribute of saying, let's identify what looks like a promising innovation that is facing a regulatory ambiguity or barrier. And then let's understand, let's test and see, does it really do the good things that it's promising? And what can we understand about the regulatory barrier? And some of them are run on, you know, matter of months and the test is over. The one in Abu Dhabi, I think, runs for 2 years. There's a lot of different formats for that. The UK has also innovated the RegTech Tech Sprint concept, which is not exactly a sandbox, but it's a concentrated hackathon where the fintech and banks and tech firms and academics and regulators all come together and work on solving a problem together, writing code by the end of it. That's not exactly a sandbox, but it's another regulator innovation on how to learn to change.
Just a couple observations on sandboxes. So one, I think, was well articulated in the panel earlier with state regulators and AGs, where I think they, pretty convincingly beat back the myth that it's some sort of, free-for-all in a sandbox. And at RegTech Lab, we did a review of every sandbox that's active globally, and literally none of them are sort of a free-for-all or hands-off zone. I think everybody has to comply with the basic regulatory requirements to participate in the sandbox. And in fact, in a lot of ways, it's a really hands-on environment where companies are actually reporting to and regularly communicating with the regulators. So they're overseen on a very direct basis in a way that in some ways is more intense supervision than companies already out in the market. So I think well-implemented, a sandbox can be a really effective tool that actually raises the bar in terms of compliance for new and innovative products that are coming through the channel. The second observation, I think, is that I tend to think of sandboxes as sort of a really important piece in a much broader toolkit. And Joanne talked about a few of them. So the basic engagement, the basic office hours that regulators have been increasingly doing, setting up an innovation office. And it's sort of a broad funnel where a lot of the issues that innovative companies are trying to solve can be addressed through basic conversations, through a little bit of informal feedback, but not all those problems can be solved in that way. And in some cases, you really do want to have sort of a live pilot environment in order to test some things out. And I think sandboxes can be really useful tools. But I just want to emphasize that I see them as part of a broader toolkit that regulators should be adopting to sort of speed up that pace of feedback between regulators and the industry. And there's a small strain in the U.S. now that seems to be pushing back on the ability of regulators to provide informal guidance, and there are some good reasons for that. I worry a little bit that we're sort of working at cross purposes in terms of making it harder to provide that level of informal feedback. So I don't know exactly where that's headed, but I just a sort of minor footnote of caution.
Just one other thing I wanted to say. I feel like I don't want to see this ever written again, so don't write this, Lydia, but I don't want to see that anyone criticizing the term sandbox. It's so ridiculous to criticize that term. And I heard first, there's parental supervision of sandbox. You can go, if you really want to maintain, this sort of toddlers playing in sandboxes, give me a break. I mean, when you're really talking about something as serious as this, you shouldn't be belittling it by getting on the terminology. And I thought someone talked about, we could call it laboratory, and then people would be not ridiculing it.
I like Reg Lab. Reg Lab is good.
Reg Lab?
Right.
Laboratory
but regardless,
innovation.
I feel like that's something that we've got to get over because it's important. I mean, these branding things in the public, if they see the soundbite of someone saying, well, only toddlers play in sandboxes, and then they start to sort of a negative, they can get a negative perspective. I feel like we need to basically get over that. We can agree on a term. I think sandbox is the internationally accepted term. We should keep that term, but let's not ridicule it. And I think, as Joanne said, regulators need to be able to experiment. They need to be able to innovate as fast as the fintech companies innovate. And without sandboxes, I don't know a mechanism that will allow that.
Right. And the terminology is a great thing to focus on, because it's like with a sandbox, we're trying to get people into the regulatory fold. So it's actually inviting, other folks mention that where they haven't seen any fraud, because fraudsters aren't going to come into the regulatory fold. So this is a mechanism to encourage people to come into this fold, to educate the regulators, and you have the guardrails there, and you can have principles associated with that, where consumer protection and the like, where that's going to be your focus, and you have this limited amount of companies that can come within the fold, and then you test it and you iterate and you learn from that. And one of the greatest opportunities, I think, are with like credit models that were in the Treasury report and using machine learning, because that is a difficult nut to crack in terms of having the right adverse action notices and everything produced there. But that has tremendous opportunity to open up credit to the under and unbanked. So no matter what we call it, we should create a framework where people can explore in that to open up credit in a responsible way. And then you put in the guardrails of you have to have this testing for fair lending to see how it's actually impacting, and we know how to do that with data. But then it needs coordination, because it can't be one state. It's great that Arizona went out to try to create an environment for sandboxes, but then you need coordination with the federal level, because you're not going to do something that Arizona blesses just to get hammered by the, I was going to say CFPB, but Bureau, so it's still tricky. But.
Well, I think Superintendent Vulo will have some comments
I
maybe
know.
later about the terminology and sandboxes. But just to drill down briefly a little bit further, because of our federal structure, any effort at having sandboxes kind of requires some sort of balance. So, Paul Watkins at the Bureau said they're focused on their no action letters and their disclosures policy. Is there anything else you'd like to see from the CFPB, or greater initiative in terms of that state and federal collaboration or coordination, whether it's sort of laying off of a company that is being overseen by the Arizona State AG or something else? I mean, can you give some specifics about what might be beneficial within the U.S. context?
I think the CFPB, they probably have the opportunity to, either be observers or, sort of say, well, we'll defer to a state who's operating a sandbox. I don't know the specific, sort of legal authorities under which they would do that, but it seems like it would maximize the efficacy of those state-led efforts, which I think are positive. Dan Kwan, in a recent American Banker op-ed, sort of formerly of Project Catalyst at the CFPB, he laid out a few authorities, broader authorities that the Bureau has to sort of bless a particular product or category of products under some of the existing consumer protection laws, and maybe that's an interesting avenue to explore.
And with a lot of the examination, so you have multiple states coming into some of the businesses to do a multi-state exam, and the CFPB coming in with that too. So they are getting used to coordinating to put less burdens on certain companies. So they could follow those kind of lessons learned there to communicate with the states that propose this through the Treasury's little push. They can come up with no action letters or other ways to kind of encourage some of the activity with the states and help frame the guardrails. So just being part of the discussion. So instead of dismissing the idea of sandboxes, it's more important just to, you can dismiss sandboxes in a sense that they would open up no rules and just do away with all regulations, or you can just say, in this environment, I agree with a sandbox with these guardrails, and then you have the federal regulators, like if these guardrails are in and we're part of the check-ins going forward, going back to the credit model test. So if we're also getting the data to ensure that we can do our fair lending analysis, then we're fine with this framework that you've come up with.
I'd like to see the Bureau. So the key to this whole thing is think big but start small. Just do it. If you look at what they did in the UK, they started so small with a lot of what they did, and then they figured it out by doing it. This doesn't come naturally to regulators to figure it out while you're doing it. We're used to having everything totally buttoned up before you put something out, and we're going to have to change that culture. So I would like to see them evolve toward actually running some experiments. I also would love to see some agencies connect up their experiments, do a joint sandbox between two agencies. Again, that would accelerate their ability to work together. And the third thing that I've been urging is to include RegTech in these experiments. One thing about RegTech is you don't have to experiment on any consumers. You don't have to make them into guinea pigs, playthings, or any of it. because it can be studying the technology that's being used either by the industry to comply or by the regulators to do their own work. And there's more leeway there, and it's necessary if we're going to accelerate the progress.
Yeah, and I think with that, we talk about the states, and I appreciated the comments from the different people from the states up here earlier, but we've got to see some, I think, more real coordination. I mean, rather than just saying we're going to, so you get like 5 states doing this or 7 states doing this. I think from an entrepreneur's looking at it, and if it's still going to be, okay, well, I don't have to register in 50 states, I've got to register in 32 entities, shall we say. That's still completely unacceptable as far as I'm concerned. You need to be able to have it so if the states should be able to, if they're going to coordinate, they want to really put themselves as an alternative to a national charter, then they need to make it a lot simpler. And they actually need to really do something broader than just like the New England states all getting together.
So speaking of national charters, Deputy Comptroller Gardner kind of gave us a laundry list earlier of requirements that OCC would be looking at, and others have mentioned the potential for litigation there for whoever is the first to apply. So in your opinion, what is it that is sort of holding any company back from being the first one up to the plate? Everybody wants to be second, but someone's got to be first.
Well, I assume litigation risk is a big part of it.
Yeah. It's mostly the litigation.
Yeah, I think there's also, it's worth stepping back and asking sort of what's this, who is this charter really tailored for? And, you can be a lender and get this charter, but it's a non-depository charter. So if you really want access to stable deposit funding, this is not the right charter for you. Payments companies might be interested, but the Fed has a bunch of questions to answer about access to Fed payment systems and so forth. So I think there are some additional unanswered questions for companies, even those who are brave enough to get over the litigation risk.
Peter, did you want to say something?
Yeah, I've spoken to different companies who are really interested in applying, but no one wants to be first. I think it's regulatory risk. I actually take a little bit of a different perspective. I think it's there's also I think there's going to be some PR value in going first. That it's going to be a risk, and there's going to the reality is this is not going to be a done deal for, I imagine, years as it litigates through the courts. But I think for a company to be seen as, I think that your company name will be used a lot in, and it's not like you're doing anything wrong. You're applying for something that is existing in its in its form as far as the OCC is concerned. So, but a lot of companies, it's going to be not just the regulatory risk, it's the additional, the opportunity cost of having all the extra work you have to do to be first. And I think that may be as big of a barrier as the regulatory risk.
I agree. It's mainly the litigation, and also some of these companies are, when they get close up to this and realize how much it takes to be a regulated national bank, I mean, it is not regulation light, as the OCC has pointed out many times. And in a way, you're trading the complexity of the state regulatory system for the burden and high bars in the national banking system. And the other thing that's happened is that the Industrial Loan Corporation charter has gained life when the OCC charter stalled. And then I don't know if it was referenced earlier, but the fact that Varo received a national bank charter a couple months ago, Varo is a pure fintech, and it has met the standards to get a regular national bank charter. And so I think there's some other pathways maybe opening up in terms of how you can get a bank charter.
Yeah, I think that's a big part of it, where if you're seeing, litigation on the threshold, but you also know you're going to have to jump through the hoops anyway, so just go for the national bank if it makes sense for your company in the first place.
Well, Comptroller Otting has often said that when fintechs and companies have come into their offices to speak with OCC regulators that they leave skid marks behind leaving the office when they find out what sort of regulation they're going to be subject to. So presumably, though, that's going to be true whether you get, not just a fintech charter, but any type of, if it's a straight up banking charter or an ILC with FDIC depository insurance. I mean, what's your perspective on how attractive becoming a bank for a fintech is going to be in the US instead of having, a bank partner or some other model?
Yeah, my view is there'll be a select elite group of fintech companies that go after this. I've never agreed with the concern. I understand that somehow this is going to kill off the state licensed fintech system. I mean, most fintechs are going to stay in that framework. And as you say, we're developing more models for partnering with banks to solve other problems. But there will be a few that know they want a national market, they have the sophistication, they do want to connect directly to the payment system, who will pursue it.
I think that that just reminded me of another good point of where the OCC has been encouraging more and more of these partnerships, and it's not like necessarily the straight partnership of marketplace lending, but just more and more of the national chartered banks leveraging the innovation at some of the fintech companies. So the more of these national banks that are open to that, these fintech companies can stay agile, avoid the regulatory hurdles, and just partner with an established bank the established banks are getting more and more open to the idea of leveraging some of the technology that these fintechs have come up with.
And I think we keep in mind too that some of the fintech companies now, some of these have been around more than 10 years, and they're still, sometimes I see them called startups. And when do you stop being a startup? Some of them are public companies, and they've done multiple billions. They've got hundreds of millions of dollars of revenue. So as Joanne said, there's only a certain type of company that's going to be that's going to appeal to, and the state system, I think, there's always going to be new companies coming in who are going to want to start off in their home state, maybe go to do 2 or 3 other states to sort of test the waters. They're not going to go and apply for a fintech charter probably for many years or a decade or more. And so I think there will still be that room for them. And when I look at the fintech landscape, I mean, you're not going to have 100 fintech chartered banks. It's just not going to be. There's just not enough companies that are that large that really could benefit from that. It's I don't know what the number is, whether it's 10 to 20, but it's certainly where we are today. It's not many dozen.
Yeah, I mean, just to put a pin in the bar that the OCC has set, one of the conditions for final approval of Vero's charter is that they raise $104 million in equity capital on day one.
Right. Seriously.
That is not a small amount of capital for a venture-funded company. So I think it's quite a high bar, and therefore means it'll sort of winnow down the crowd as you get towards the federal level, and those partnerships will be more and more attractive. And you're seeing it with some sort of fintech banks from other countries who are looking to approach the U.S. Some are approaching it through a partnership perspective first because that's just a faster way to get to market, test your product, et cetera. So.
But it is putting pressure on this question of should we be regulating by charter type or by function, and how are we going? What Councillor Phillips talked about, the fact that one of the problems is we're driving a lot of activity outside of the banks because we regulate the banks so carefully. And that also means we're driving the innovation away from the banks too. Most of the innovation is not in the banks. Some of that is good. We don't want the banks to be doing certain things, but if banks can't innovate, they're not going to be thriving. And also we'll lose oversight of the cutting edge of change in the marketplace, which a version of that happened in the subprime crisis. So we have to figure out how to make it a holistic regulatory framework.
So let's turn to a lending issue. Do you see any tension in the report in terms of its recommendations for small dollar lending and really trying to encourage banks to get back into that space? U.S. Bank recently announced a new small dollar product, but others have questioned whether that and the OCC's effort in that are enough, and whether all of the administration's recommendations sort of are going to work together in a way that is necessary to drive that activity.
So I think this is a big, one of the biggest opportunities, I think, is to really bring more, more best practices, more win-win practices to the small dollar lending space. Because I feel like when you say small dollar lending, everyone just immediately jumps to predatory payday lending, which is, where you have these rollover loans, you can take a $500 loan and end up having to pay back $3,000. And clearly, that is a horrible situation that should not be allowed. But if you do a $500 loan and you have to pay back $600, and so that's $100, may even be say it's a 3-month loan, it's $100 of interest, that's 80% APR. But is that a horrible product? And I would argue that it's not. And if we really are serious about financial inclusion, and Councillor Phillips talked about it with how these online lending platforms are enabling this more. If we're serious about it, then I think we need to differentiate between predatory lending and if someone who's paying $100 for a $500 loan, because I know there's a lot of people here who thinks 80% interest rate, never. That is absolutely unacceptable. We can't have that. And I would argue that if that's your attitude, then they, on the other hand, they say, well, we need more people to get access to credit. Well, you can't have it both ways because we're running a for-profit business here. We need to be able to have, $100 of interest. There's even with that kind of loan, there's not a whole lot of space in there for profits. So what I want to get away from, and I think that's what the Treasury report is getting at, is this, getting into a more responsible small dollar lending space. I think what US Bank did is, I think it's great that the banks are coming back in.
Yeah, I think that's a good sign. I think banks are thinking about it again after the old guidance was taken away. But it's going to be a challenge. And the FDIC ran a pilot several years ago around small dollar consumer lending by banks, and it turned out that it was hard to make that profitable. That said, if banks are looking at a customer relationship from a longer term perspective, this is an important product that consumers obviously want. The payday industry is not small. Almost everybody who gets a payday loan is almost by definition actually has a bank account because you need one in order to get your payday loan. So this is a product and a service that consumers want and apparently need in a lot of cases, and is not being provided by the banking system. So I think it'd be really nice to find ways to do that. There was. Lydia asked about tension. I think one of my criticisms of the Treasury report was that it recommended doing away with the Bureau's proposed rules around non-bank payday lending, and I think that's a step backwards. I think we should be raising the bar for compliance in terms of these kind of loans, and encouraging, on the one hand, encouraging banks to get into it, and on the other hand, making it harder for the predatory types to exist. So.
But it's the technology that has made it possible to serve more customers profitably. Globally, we know the World Bank has a goal of having every adult in the world have a bank account in their phone by 2020. And we're not going to hit that, but we're going to hit it in the 2020s for sure. Everybody has access now at least to a transaction account. We have to do the US equivalent of delivering. Millennials are the largest generation in the history of the world in the US and globally. Deliver these services through the mobile phone, make the back office efficient, which it hasn't been. There's innovation, use data differently. A lot of these people are not served because it's too hard to underwrite them with conventional data. And as we use the new data and can really fine-tune that process, we're going to be able to do sound and profitable lending to vastly more people. So the FDIC model was in the analog age, and now we're in the digital age.
Correct.
Right, so I have a couple more questions, but first I want to see if anyone wants to grab hold of the blue box microphone. Yes, we have a question up front. 1 second. You want to raise your hand? And can you say your name and who you're with when you ask your question? Got one right here. Second row.
Gotta throw it.
That's what it's for.
There we go.
That's
No.
Chief Technology Officer.
Once more.
Quillian kind of invented these. So I love them.
No, you're good, you're good. No? Here.
Throw it.
There we go.
Okay.
There we go.
Yeah, I'm Ilaf Elad. I'm at Shanghai University of International Economics and Business. I'm an academic. And just hearing, I think today, if you like, the very panelists and keynotes, I would like to maybe make an appeal. I think from an academic point of view, you see blockchain, Bitcoin, and online lending. And now, for example, the new thing about sandboxes, I think what will be very interesting to have is that the data that are being generated doing those sandboxes to be made available to researchers, because you've seen it, for example, my research is based on a lending club and Prosper data, which are easily available in terms of the marketplace and transparency of data. And that is, I think, a great opportunity, I think, both for regulators to have some academics analyze the data, as well as for academia to understand these new technologies. So I don't know if there's any developments or thoughts from policy side or from industry to have more data being made available to, if you like, public researchers. Thanks.
Anyone on the panel want to field that?
I think as long as it's anonymized, I think that goes into how you make the sandboxes work really well, is you give the guardrails and you make all the data available, and then you have check-ins, and that's when you can bring in multiple regulators to kind of see what the data is telling you, because it's obviously more information than any, especially in the analog age, anyone can really comprehend. But now with data analytics, you can comprehend the data, and academics like you can really play around with the data to see who is it, what's the consumer profile look like, who's coming into the fold that recently might not have been in the fold, and where you can make certain bets. And that goes into this small dollar lending, where there's some that it's a good bet, and the data might say, like, it's not profitable unless it's you charge $100, but in this small population, you can actually just charge 50 and like not even think about it, because the data kind of makes the decision for you. So I'm all for that.
And there's new technologies for anonymizing the data too. That's making it safer to be able to share.
Let's see if we have any other. I don't think I see anyone. So real quick, briefly, like a flash round. Let's talk about the politics of fintech. Earlier this year, the House passed the so-called Madden fix, which is very important to many people in this room, I think. But that seems to have died in Senate in part because that issue's been very politicized. However, other aspects of fintech do tend to be bipartisan, and Congressman Meeks earlier said that he would like to drive his committee, the Financial Services Committee, in a more bipartisan direction. And then, of course, we have all of the state and federal issues, notably the litigation over the OCC's fintech charter. So, briefly, where do you guys view sort of that political framework? How's that shaping up for the next year, and where do you think there's going to be opportunities for more bipartisanship?
Well, I started off very positive on that front in my first remarks, and I think by and large, I hope that's still true. Maybe that's aspirational. Maybe it's naive. I do think, beginning with Madden and now creeping into some other issues, including around data privacy and sort of post-Equifax breach. There's been some concern, and there have been a couple hearings, one on the Senate side, one on the House side recently, where partisan lines are starting to be drawn. So I'm a little bit worried that the bloom is starting to come off the road for fintech, that it's starting to become viewed as more of a partisan issue. I think that will continue if sort of being pro-fintech comes to be viewed, certainly by the Democratic side, as sort of consistent with a broader deregulatory push. So I think trying to keep fintech out of that regulation versus deregulation fray would be helpful in maintaining some of its bipartisan allure.
I think convening experts like the OPI does with this summit is a way to get the dialogue going, to avoid sound bites, so it avoids partisan issues. It's getting to what's at the root cause, at the root of like what we're all trying to accomplish. And there's more areas we agree on than disagree on. And I mean, Con Hurley's the director of OPI, and he's a huge Democrat. So I think there's a lot of folks that can, there's more things we can agree on. And a couple of the other rooms, it was one of the state regulators was talking about, started talking about payday lending and 300% APR, and that's the soundbite. And then Adam Galler kind of said, let's walk that back, because what you see in marketplace lending is actually 30% or 36%, and there was agreement there. Like, yeah, if it's under 36%, I think we can all agree that's not predatory. So there is a lot of agreement, and we just have to focus on those initiatives and kind of push that forward.
Peter, Joanne, briefly.
Did you all see the picture online a couple months ago with a kid at a computer and Mark Zuckerberg looking over his shoulder, and the kid is saying, "My dad says you're spying on us," and Zuckerberg is saying, "He's not your dad."
I never saw that. That's great.
So I agree, the bloom is coming off the rose on fintech and tech, and I think we're in a race against time to tell this positive story and to put up a good regulatory framework around it that'll make people trust it and want it.
Yeah, and just adding on that briefly, I think we need to focus more on the innovation and access that we're providing. Those things should be bipartisan. I think everyone wants us to move forward. They just don't want people to get screwed in the process. And I think if we focus on the innovation, I think that's what really needs to happen. And I would also even say what my first point was: focus on the fact that we don't want to be left behind, and we have a risk of being left behind. America it's the largest economy in the world, and there's so much innovation. Entrepreneurship here is incredible. The ideas that people come up with, I think we need to harness that and to really encourage that, and I think, so focusing on the innovation piece, that's I think we need to really hammer that message in Washington.
Okay, thank you. We're out of time. Thank you to our panelists.
Okay, thank you.